When I started my first LLC, I had no clue what I was doing. I remember transferring money from PayPal straight into my checking account and really just calling it a day with no records, no structure, and no plan at all. And guess what? Come tax season, that's when reality hit. My accountant looked at me with that look that your parents give you when you get caught in that lie after they ask you, did you clean that room? And you know darn well you didn't. Yeah, I see the same thing happen to small business owners every single day. Hey, my name is Michael Charles. I help business owners and entrepreneurs repair their credit and leverage it to unlock business funding. And the truth is, it doesn't matter if you're just starting your LLC or you've been running your business for a while. If your credit and your money systems aren't set up right, you're leaving opportunities and protection on the table. On this channel, I break down credit, funding, and business strategies so you can grow smarter, faster, and with less stress. If this sounds like something you need, go ahead and hit the subscribe button and turn on notifications so you don't miss out on the next strategy. All right, so here's what we're going to cover in this video. First, I'm going to break down exactly what an owner's draw is and why it's the safest way to pay yourself for your LLC. And then I'm going to give you 3 simple steps to set it up the right way so you can avoid the mistakes that trip up new business owners. We'll also go over the biggest money mistakes that LLC owners make every single day and how you can set up a system that keeps you protected and stress-free at tax time. After that, I'll cover the tax basis every LLC owner needs to know, and also when it actually makes sense to switch over to an S-Corp to save thousands of dollars. And finally, I'll show you why paying yourself is just the first step and how building a strong credit can open doors to $50,000 and $100,000 in business funding. So stick with me all the way through, because if you miss one simple part of this, it could cost you big time. All right, let's go ahead and jump into part 1. So what's an owner's draw? First thing that you need to know is that as a owner of an LLC, the most common way to pay yourself is through an owner's draw. That simply means transferring money from your LLC's bank account into your personal account. Once it's in your personal account, you can use it for your own use. Here's the big thing that most people miss. You always need to keep your business finances and your personal finances separate. Here's why. Imagine your business gets audited and you're mixing up your personal and your business expenses. The IRS or even the courts, they could say that you've pierced the corporate veil. That means they can come after your personal assets, your car, your home, or even your savings. That's the complete opposite of why you set up the LLC in the first place. So think of an owner's draw as an official IRS approved way to move money to yourself without risking that protection. And here's the 3 steps to set up an owner's draw. First, you need to make sure that you set up an EIN. That's your employer identification number. It's issued by the IRS and you can get that online absolutely free. Think of your EIN as your business social security number. Step 2, open a business bank account. This is where many business owners cut corners. They use their own personal accounts because it's easier and they already have it set up, but that's a shortcut and could cost you later on. A business account isn't just safer, it also makes bookkeeping and getting funding that much easier. Banks and lenders want to see clean business finances. In step 3, transfer money to yourself. Once your business has earned money, pay yourself by transferring funds from the business bank account to your personal account. Do it with checks or bank transfers. This keeps a paper trail. Always record the date, the amount, and the purpose in your bookkeeping. And some tools that I use to do this are softwares like QuickBooks, Wave, and even using a simple spreadsheet can work. Your future self will thank you around tax time. And the common mistake to avoid in this process, and believe me, this is where new business owners mess up, withdrawing too much money too soon. Money's flowing in your business and you pull it out as soon as it comes in. And once it comes in, you're just using it for whatever, forgetting about self-employment taxes. On top of income taxes, LLC owners pay a 15.3% in self-employment tax. Not having that available by the end of the year is going to cost you. Here's an example. So let's say your business is making $130,000 a year and you spend $70,000 on expenses and you're paying yourself $60,000. You're leaving behind nothing. A smarter move is to build 3 separate accounts. A checking account, or more so a business checking account where your income and expenses go, an owner's pay account, this is your personal account, and a tax savings account where you set aside 25 to 35% automatically. That way, you'll never be blindsided when it's time to file your taxes. These are real simple tax basics that you need to know. An LLC is a pass-through entity. Profits pass directly to you and you pay taxes on them. So the key point in this is that you owe taxes on profits whether you transfer them out or you transfer them in. Leaving money in your LLC bank account does not save you on taxes. Now, the good news of the switch is you're not getting double taxed like a C-Corp would. If your LLC makes over $100,000 in profit, that income can pass directly to you and you pay taxes one time. Remember, your LLC gives you a limited liability protection, but only if your books are clean, no commingling. So you may be asking, when is it time to switch to an S-Corp? Now let's go ahead and start talking about scaling. As profit grows, that 15.3% self-employment tax can get really painful. That's when it makes sense to switch from an LLC to an S-Corp. With an S-Corp, you can split income into two parts: a responsible salary that's taxed with payroll taxes, and owner's distribution that's not subject to self-employment tax. So here's another example. Your LLC makes a profit of $120,000. As a regular LLC, you pay self-employment tax on that $120,000. As an S-Corp, maybe you pay yourself $60,000 in salary, right? And $60,000 as a distribution. You still pay payroll taxes on the salary. And the distribution, you can skip the whole entire 15.3%. That could save you thousands of dollars every single year. So let's recap real quick. Pay yourself with an owner's draw. You want to make sure that you keep your personal and business money separate and always plan for taxes and expenses. And as you scale, consider switching to an S-Corp. But here's what most people miss. Paying yourself correctly is only half the battle. The other half is building strong credit so your LLC can qualify for $50,000 or $100,000 in funding. That's what I help business owners do every single day. So if you want to repair your credit and optimize it and unlock high-limit credit cards and business funding for your LLC, hit the link in the description and let's get started. Thanks for watching. And don't forget to like, comment, and subscribe for more strategies to grow your business the smart way.